In this video, traders, we're going to look at using price oscillators in a trending market. Unusual. Stay tuned. Hey traders, a very warm welcome to you. Okay, so general textbook rules will state that you should use oscillators in a range-bound market. When the market's ranging, you look at your nice RSI, your stochastic, your CCI, all those kind of stuff, and you say, oh, you know what, I sell it when it's overbought, I buy it when it's oversold, I sell it when it's overbought, I cover, blah, 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 you know the score, and we kind of oscillate between 0 and 100. That's all very well, and they work very nicely in those kind of conditions. I can't argue with that. However, I think they are very powerful during trending conditions. Let me show you the way that I like to use them. So you've got to be careful here, right? Let's say this is our oscillator section here. We've got a nice trending market chugging along. Now, what normally happens with oscillators is they will go into an overbought territory. I'll just use this purple pen here. We'll call that overbought territory here, and we'll call this oversold territory here. Now, normally what would happen when you're in a trending market, as if you're aware, if you're watching any oscillators in trending market, they kind of sit around, then they sit in overbought or they dip down a little bit. They kind of sit in the top half, if not overbought, for a long, long time. And people will say, hey, you can't use an oscillator there because if you go short, you're going to get smashed. And of course you are. You're going to get your face completely cleaned off if you're going short on the first overbought condition and you're staying short just because it's overbought. That's why how people misuse oscillators in trend environments. However, when you get a pullback on the trend, a first kind of decent enough pullback, whatever market you're looking at, whether it's a daily, time frame we're looking at, daily, hourly, 4 hourly, 15 minute, the first kind of pullback, we get these little pullbacks here, and generally they're kind of hugging a 5 period if it's aggressive, or a 10 period moving average. We get this bigger pullback, maybe takes out some stops. It's a bit of a deeper unwinding, multiple days on a daily chart, you know, multiple hours on an hourly chart, but not really intruding too much into this move. Let's, you know, whatever percentage of move that is, or whatever number of pips or points move that is, not really intruding too much into that, just a kind of healthy pullback. You will often get the oscillator going into oversold territory for the first time in a long, long while. Now, I'd like to stand here and say to you, hey, I've back tested this and I know that the exact sweet spot for this is when this has been overbought for X period of time. I don't know. I just observed this from eyeball and it's a pretty good way of trading. So what you do is you wait for that scenario, you eyeball a trend, whether you want to use an ADX, whether you want to just look at it and visually do it, which is the way that I do things, old school. Look at it, it's a trend, it's starting to pull back, stick your oscillator up, have a look, has it pulled back into oversold condition since we kind of broke out or started the trend? Again, however you want to kind of frame that. No, it hasn't, right, we're now oversold. As it starts to curl back up into neutral territory out of oversold, there's your buy point. You're long, and you know, you can choose how to do your stop. You can choose whether to use an ATR stop. You can choose, more than likely going to be a little bit late on that, so maybe you can go under that low or stop under that low plus an ATR or whatever it may be. You're going to be long probably from about there by the time this curls up off that oversold, extreme oversold condition, out of oversold into kind of neutral condition, depending on, you know, how you label that. But you know what I mean, coming off there straight back up through that 20 level most of the time on an RSI or a stochastic, buying it there, having a stop there, looking for a further push to highs, or ignoring price altogether and just say, hey, as soon as that oscillator gets back into overbought territory, then I'm going to close the position and come out of it. And obviously flip it on the reverse side if you are looking at a short. So it's a different way of doing it. It's basically saying, hey, you know what? I'm not going to look at an oscillator. It's useless while it's trending. However, when it comes down, it does a first kind of oversold. It's almost like a first unwinding. There's likely to be one more shove back in the direction. Will it carry on motoring? Who knows? Is it likely to shove? In my experience, it's likely to have one more shove. Will it fail at the high? It could do. But by that time, you're probably going to be overbought. And the idea of this is, well, the foundation of it is that you take it out when it's overbought. If you want to add more flavor to that and manage it into a longer term trade, then so be it. But then the kind of crux of this deal is, hey, that's the sweet spot to get in as it's crossing back above that. You can quantify your risk again, however you see fit. And then the sweet spot is to get out there. If you want to extend the trade by kind of holding stuff, then finally use that as a first pullback for multi-month move, then so be it. But That's worth looking at, guys. If you're kind of swing trading stuff, or if you're day trading and you're struggling on these trend days, using an oscillator, RSI, CCI, Stochastic, and the other ones that I've missed. Standard one will do. No special settings, just use the default settings. Don't play around with it too much. Just kind of take it for what it is. All right, guys, thumbs up if you like this kind of stuff. See you in the next one. Take care. Goodbye.